What is happening, YouTube? Actually, I need to bring my microphone over. What is happening, everybody? Futures Brizio here. It is Friday, July the 10th. It is almost 7 p.m. New York City time. And I hope everybody has had a great week. As you guys know, I was away again this past week for the Independence Day holiday here in the U.S. I got back Wednesday night, so it's been a little bit crazy since I've been back, and I just did not have time to make any videos in the last couple of days. I did try to record a walk and talk video on the 4th of July. I was at the beach up in New England. Beautiful, beautiful day on, what was that, last Saturday, a week ago tomorrow. And I don't know what happened. I was recording it live while I was walking down the beach. I was, showing you guys some of the beautiful weather and the waves and the beach. And then I was talking about something about trading. I kind of sat down on some of the rocks at the end of one of the beaches. And it was about a 20-minute walk and talk. And then I ended it and I posted it. And when I went back and looked later, it was only 56 seconds. The whole thing that actually uploaded to YouTube was 56 seconds. It basically was like the first minute that I was recording. So I have no idea what happened. I guess I must have hit something while I was walking. I hit something on the phone and ended it. I really don't know. Kind of frustrating because I was like talking to nobody the whole time. So the 56 seconds was originally posted, and then I took it down a couple of days ago because there was no point. There was nothing there. It was just the very beginning of me talking. So anyway, so that was my one attempt to make a video while I was away, and that didn't work out too well. So it's been a minute since I recorded a video, and I hope everybody's had a great week. I am back home here and looking outside right now. We're about to get a nasty little thunderstorm. So hopefully I don't lose power. Well, I have a generator, but still kind of dark and rumbly out there right now. So anyways, make sure you smash the like button, subscribe to the channel, questions, comments, leave them down below, and we will jump right into this. And we're going to take a step back from the currency strength indicator, and we're going to talk about something here which is kind of cool, and let's just go through it. So if you're looking at my screen here, you're seeing these what look like candlesticks, and they probably look a little bit funky to you. They don't look quite like normal candlesticks, and they're not. And these are called range candles. This is available on TradingView. Now, it might be available on other platforms as well. I don't know. I'm not familiar. I only use TradingView and MetaTrader. They're not available on MetaTrader. Maybe there's a plugin for it, a custom indicator, but not available as a regular thing on MetaTrader. But it is available on TradingView. And we're going to talk about how these can be used, why they're different, and how they're kind of cool. And you can take it for what it's worth. So now, of course, you could use this in conjunction with something like the CSI, but I'm not sure how it would work because, well, for reasons I'll get into. Okay, so in Meta, if you are a user of TradingView, you want to go to your drop down here where it shows your candlestick types. Now, I have a paid version of TradingView, so if you have the free version, I'm not sure if this is available. And if it's not, then I apologize. You can either just finish watching this video as information, especially if you've ever thought about upgrading to a paid version. So I don't know. So I will put that disclaimer out right now. If you're a free TradingView user, you may not be able to use these. If you are a free TradingView user and you know the answer to this question, leave me a comment. I would just like to know. But if you can get them, so you click the drop down here up top where it shows your candle types, and you scroll down. I know you can't see it because I just realized that it cuts off the bottom of my screen, but there's one right here that says range. You can just see it's in black, and you click that. And then what it's going to do is going to add this little icon right here, which shows these little bars with the little R next to it. Now, within that, you can set these to whatever you want. So if you double click on it, these what it actually shows, you can easily leave them as candles, which is I have, or you can make them bars if you rather use bars, like good old fashioned bar charts before the day of candlesticks. I prefer candles, so we're going to leave it as candles. And of course, you can change the colors. I'm just going to leave them with the red and green, which are not my favorite, but for the point of this video, it's fine. And so you've got, typical candlesticks color, and then you have what they call projection candles, which I will talk about as we get into how to use this. And so those are the settings you can choose from in terms of colors and that sort of thing, and type. Now, the other setting, now let me explain to you how these work. Now, depending what market you trade, it's going to be a little bit different definition, but we're going to talk about Forex, okay? Now, these are not time-based candlesticks. So again, if you're on like a daily chart, then you know that every candle represents 1 day of trading activity. If you're on the 1 minute chart, every candle represents 1 minute of trading activity. These are price-based candles and not time-based. So you can't necessarily just look at these and say, well, what time frame you're on. Well, you're not on a time frame. You are only using it based on the range that you set. So I have it right now set on 5. Now you can change the interval. And again, I don't think you can see it. Well, you can see some of it. So down here where it says ranges, one range 10, it defaults to 110 and 1000, which I know you can't see the 1000. But like anything else, TradingView lets you customize and put in whatever intervals you want. You can do the same thing on, regular time frame charts like candles, right? You can go here and you can add, an 8-minute chart if you want, or a 3.5 hour chart if you want, so it'll let you do that. So if you want to add custom intervals, you just click where it says add custom interval, and these are range. So we change this to range, and you put in whatever you want. So I added 250 and 500. Okay. And I'll talk about why I did that. And so now, and I also added 89, which I don't really use. So I'm working, and I added 350 because I was playing around with some back testing, but 250 and 500 is really mainly the two that I use. And you can think about it, and you probably can answer this question before I tell you anything else, is what do you think the main difference is between using one range setting over the next? So I'll give you a second to think about it. Pretty obvious when you hear the answer if you haven't thought about it. But the answer is that it's granularity. It's how much detail it shows. So it almost mimics using different time frames, even though it's not time frame based. Okay? And I'll tell you why that's important also for me. Okay, so I have it set on 500R right now. Now, Forex, in order to calculate pips, if you're like an old MetaTrader user, the candlesticks will show in what they call points. And points is basically pips with an extra decimal point to the right. Okay. So you want to convert this to pips. So again, each one of these candles represents a certain range, or in this case, a certain number of pips. Okay. And it will not draw another candle until that set number of pips that you have selected has been satisfied. Okay. So I'll say that again. It's going to only draw candlesticks when a preset number of pips has been, the chart has moved up or down the preset number of pips that you select in this interval. Okay. In this case, it's 500, which is 50 pips. Okay. So every one of these candles you see on my chart is 50 pips. And I can validate that with the measuring tool. We'll take this little green one that's right here, and we'll use the measuring tool. Click from the bottom to the top. It's hard to get it exact, but you can see there 47.9. It's 50. It's just it's really hard to pin it exactly. So, but it's 50 pips. So every one of these candles is 50 pips. Now, obviously, like I said, the shorter you make this number, the more granularity you're going to get. But that's not necessarily, a better thing. So if we just look at like this area right here, All right, let's just look at this area right here. You can see it's set for 50 pips. So if I change this to 10, okay, well, it takes that whole, it erases my little box there, I guess. Well, I wanted you to see it. Let me go back to 500. Go back over here. Okay, well, this goes from, let's look at the date. I mean, even though this is not time-based, you still can see when everything happened. This went from June 25th around 10 o'clock at night to now, okay? So June 25th, 10 o'clock, remember that number. So now we go back to, let's say, 10, and let's go back to June 25th now. June 25th. That's July. Oh, God, we have to go way back. We're in July here. All right. Oh, you can see what I'm talking about, right? Look how far back I have to scroll. So you saw on the 500 chart those few little candles, right? Now I have to go all the way back to June, which I'm not even going to be able to do probably. So you can see what the difference is just in the granularity, okay? So for me, you guys know I like to trade on higher time frames. Okay, I like to trade on the 4-hour and the daily. I'm not a scalper. I'm really not even a day trader. I'm like, a light to moderate swing trader. Okay. So for me, I wanted to see, like, kind of make the chart look as good as I could, like a daily chart. So I started playing around with the ranges. And again, don't get confused because these are not time-based candles. These are price-based candles. And I found that 500 is pretty equivalent to what the day chart looks like, just in terms of the patterns, the overall movement of the market. I'm not talking about the individual candlesticks. I'm talking about just the pattern, like this up and then this down and then this down, like this range down here, right? The overall big moves in the market. And to prove that, what I'm going to do is I'm going to add a second window. This is the Aussie US dollar. So we're going to add this second window. And we're going to go over to this and change this one back to candles. All right, so these are candles. And we have the Aussie dollar. And we're going to go to the daily chart. And now I want you to look. And we'll zoom out on this one a little bit. So make it look a little bit more like the one on the right. And now you can see these are fairly close. They're not exact. But here's the regular, on the right, the purple and blue candles. This is the regular candlestick chart, daily chart of the Aussie dollar. And over here, you have the range bars, okay? And you can see there is still a little bit more granularity with these, but overall, it's pretty close. And it basically slows the chart down enough so that it almost mimics a daily chart, okay? Now, again, it's not precise. And if you want to use these, you can just play around and use whatever granularity you like, okay? And I think it really depends on how you like to trade. If you are more of a scalper or a swing trader, you're going to use the very short ranges. You're going to use the 1 or the 10 or maybe even a 5 or something small, because remember, a 10 is going to be 1 pip. So every candle is going to be 1 pip. Well, if you're a scalper, you're only probably looking for 5, 10, 20 pips anyways. And so you can't have a range bar that's 50 pips because you can't do that if you're a scalper. And you probably can't even do it if you're just short-term day trading either, because some of these assets don't even move 50 pips in a day, or barely, right? So the number of ranges that you set on this indicator is really going to depend on two things. One, how much granularity you like to see, but more importantly, what your trading style is. Are you going to be a fast trader where you're just scalping, going to be in and out? You're going to take several trades a day and basically a scalping type mentality, or a day trading. In that case, you want to pick a shorter range, okay, and do that. So again, for a scalper, I'd say, anywhere from 1, which is, 1 is 0.1 pips. That's probably too short. But maybe you're going to do 5 or 10, right? Half a pip, maybe 20, 2 pips, right? Because remember, it's whatever the number is divided by 10. So if it's a 20 range, it's 2 pips. Each candle is 2 pips. So again, it kind of depends on what is your trading style. How do you like to trade? Me, I prefer to swing trade. I don't necessarily want to uh, close my trades the same day, and I'm certainly not a scalper. I can't say I never day trade. There are times where I take a trade and close it the same day. For the most part, I try to hold my trades, at least a couple of days. All right. So because of that, I want to use a higher range because I want to slow things down. I don't need to see granularity where the range candles are drawing every 2 pips or 5 pips or even 10 pips, right? I can slow the market down. And I also think doing that shows me more clear market structure too, without all the noise. It's the same reason why you'd want to trade on a higher time frame versus a lower time frame if you're trading, regular time-based candlesticks, because you don't want all that noise. You don't want to trade the noise. You don't have time to sit there and stare at the charts and wait for every little motion. I mean, if that's what you like to do, then cool. All right, more power to you. But so basically, that's how you choose the range. And you have to experiment a little bit with it, of course, and see what works for you. But the first thing you need to ask yourself is, what type of trader are you in terms of how long you like to sit in front of the charts? And are you a scalper? Are you a day trader? Are you a swing trader? Are you a position trader? That will determine mostly what you set this range for. Okay. And again, a 500 range bar is a 50 pip. Each one of these candles is about 50 pips. So anywhere between about 250 and 500 is about where I like to sit. Whether it's 250, 300, 400, 500. So like I said, I set 250, 350, 500. I don't really use the 350, but somewhere in this range is good. The 250 looks more like a 4-hour chart. If I set this to 250, okay, if I go over here again, let me change this to 250. All right, and then we go back over here. I change this one. I want to change this back to candlesticks on the right. So now here's 250 here. Whoops, no, still says 500. 250. No. Oh my God, I keep changing it. Okay, I gotta go back over. Okay, so we got 250 on the left. The red and green are the range charts set to 250. And then we are at the Aussie dollar over here. We're going to go to a 4-hour chart, and we're going to zoom out to make it look a little bit more like the one on the right, on the left. And now you can see we did from this high, and you can see my crosshair is synced up on the two charts. And you can see it's pretty close, right? And just in terms of how it looks, okay? So again, if you're like a mid time frame 4-hour swing trader, 250 is a pretty good number. Okay, at least in Forex. Okay, if you're more of a longer term swing trader or you just don't want to really see that much detail, 500 is going to look more like a daily chart. Okay, and again, you can experiment with it. And again, the main thing is you have to ask yourself is, what type of trader are you in terms of how long you like to be in trades, when you like to enter. All right, so I'm going to get rid of this regular candlestick chart. We'll go back just to the range, and I'm going to turn this back to 500. Okay, so we've already established what range bars are. Okay, so basically, like I said, this will not draw another bar until prices moved 50 pips. The minute it hits 50, whether it's up or down, it's going to paint a bar, a candle. Obviously, if it's a green candle, that means it moved up 50 pips. If it's a red candle, it's going to move down 50. That means it moved down 50 pips on the underlying time-based chart, okay? If the price happens to chop around and goes for 8 or 10 hours and doesn't move 50 pips, it's not going to draw a new candlestick until that happens. All right, I think there's an example here. Yeah, we can go with this. Really, any of these. But this one's pretty good. How about over here? I'm just looking at the times. Whatever. Okay, let's go with this. All right, so you can see down at the bottom, Monday, you can see the time and date at the bottom. Monday, June 29th at 21:07, which that's in my time zone, that's going to be 9:00 p.m. Price moved 50 pips. Is during the Asian session, pop 50 pips, okay, at 9:00. The next candle did not form until the next morning. So remember, this was June 29th in the evening, 9 p.m. This is June 30th, so the next day at almost 11 a.m. So this was like 14 hours later before the next candle, before the price moved 50 pips. All right, so the time between here and here is like 14 hours. Because between 2107, between 907 and 10:49 a.m. the next day, price did not move beyond 50 pips. So no candle painted. Okay, now if you look at an hourly chart, let's say, there's going to be 14 hourly candles between here and here, right? Now there's only 2. Now, again, if I set this to 250, it's going to obviously explode that number. Not explode it, but it's going to be quite a bit more. If we change this to 250, we look here. Here's that same 2107. Now we're at 250. So this is 25 pips. And then, of course, since we saw it on the 500, there was one big green stick. So 25 and 25 is 50. This is that one big candlestick. But you can see that went from 9 o'clock. So at 9 o'clock, it went 25 pips. It took until the next morning at 9 o'clock, so 12 hours later, for it to move another 25 pips, okay? And you can see it's showing you the same thing, just more detail, okay? Because each one of these is only 25 pips as opposed to 50. Now, how much detail you like to see is up to you. I don't think you can really use just one. I think the way I've been experimenting using this is I start on the 500 because I want to see the bigger picture. And then when I'm thinking about entry point, I'll go down to the 250 and I'll look for a little bit more granularity to maybe see a change of market structure, right? If I'm waiting for this down, like if this downtrend was going to continue, then, I'd be coming in here and say, all right, I was on the 250 and now I'm going to go to the 500. I'm going to go down to the 250 and I'm going to wait for one of these swing lows to be broken, okay, aggressively, and then we'll see that down. Now, what this does, because of the slower action in terms of, if you set this to 250 or 500, it's going to make you sit on your hands a lot longer because you're not going to just be jumping in on the next red candle, right? Because you can see it's very plain. The market structure shows really well, even on the 250. Right? So price had this low, came up. You can see this nice little structure right here. And price went up. There's a nice little structure right here. Went up again. And I don't know if this will be structure right here or not. The market's closed now, so we'll have to see. Okay? Or you can go, theoretically, you could stay on the 500. And then you can see on the 500, okay, we have not broken any market structure. We had price pull back right here. Now, of course, you could have gone short right here thinking, okay, the downtrend's going to continue right here. Well, if you did that, you probably would have been stopped out because you can see this candle right here. You're like, oh, the downtrend's continuing, right? We're making lower highs, lower lows, but then all of a sudden, boom, you get this big candle come up here. Well, now we've got a higher low. So now I would want to see, this structure area right here breached before I would think about going short. So now you can either wait on the 500 range for a big red candle come out and take out this low, okay? Or if you think, well, price is probably going to go higher now, then you just wait for price to break this new range that's formed right here. A breakout above this high would probably take you up to another new high, okay? So you can wait for a pullback and for a higher low to form, or you can wait for a breakout if you want to be a little more conservative. Taking a breakout is going to give you a lower risk to reward ratio because now your stop loss will have to be lower. But the nice thing is because these are range-based charts, as this is coming down, if it doesn't break here, if you see red candle, or one red candle and it stops, and the next candle is a big green candle, you can be pretty assured that that market's still going up. Kind of like what we saw here, one red candle. This was our lower high, our swing low was right here before this happened. Then it came up, we had this red candle. This low was not breached. And then all of a sudden we get this big green candle. But you can see this green candle did not take out this high. And so to me, the range right now is basically right here at this low, okay, and right here at this high. So this is our range right now. And that's not why they call them range bars, but it's kind of the same thing. So we'll take off these arrows. All right. And so to me, this is the range right now. A break above here probably is going to go higher. Break below here means we'll probably continue the downtrend. We do have a major swing low here. So if I did take a short, I'd probably be targeting back down towards this, recent low here. Actually, it's not reaching. You can see this goes back to the end of March. This low was put in 3.5, 3 months ago, 3+ months ago. This low was put in because, again, these are not time-based candles. These are price-based candles. All right. So again, the setting for the range is going to depend on how much granularity you want to see, what type of trader you are. Okay. So, and you can see, you might have to sit on your hands for a while because you could go hours and hours and hours and hours and hours, and maybe a day, depending what setting you have the range on before you see another candle paint. Okay. Now, the other thing I want to point out are these, what they call the projection bars. Let me take this off. You can see right here, and this is always going to be the new candle. Okay. See this little red candle? It's kind of like shadowy. It's not as deep red as this little shadow candle. Well, that's just the next candle building. Okay. Now it's not going to turn bright red and paint as a closed candle until, again, it meets whatever the range is. And again, in this case, 50 pips. But it's showing you that as this candle is forming, at least right now, okay, at least right now, it was starting to form to the downside. Okay, that's why it's red. If that candle was starting to form upwards, it would be green. Okay, I don't know how helpful that is because until the candle paints, it doesn't matter. It could start off as a red candle and then all of a sudden turn green or vice versa. So I don't really know how useful that projection is because, like I said, until it actually closes, meaning it hits 50 pips in this case, that could change. But I suppose people maybe want to look at it and say, okay, well, it's getting close to 50 pips and it's red. Like if it's heading down, it does, and it looks like maybe it's going to close lower. It's going to close red. It's going to close near the low. I'm going to take a short before it even gets there, a little more aggressive, put my stop above this high and just go for it. I suppose you could do that. Of course, you run the risk, though, that as the candle closes, comes down into this structure area, it drops a big wick, big rejection candle. Maybe it does close lower, but there's a big rejection off this low. Maybe it even closes higher and all of a sudden turns green and closes higher. Maybe it stops you out. I don't know. So, but that's what these little candles are. These are, excuse me, projection candles. See if I can find a green one. Yeah, here's a green one. So this is dollar yen. I just found an opposite dollar. So you can see this one right here. This is how the market closed, and it's this green projection candle. So it's shadowy. It's kind of a little bit more translucent because it hasn't hit 50 pips yet. But when it was forming, it was going up. Okay. So ultimately, what will it close? Will it close higher and close green, or will it reverse and close lower? Okay, I don't know. So, but those are the projection candles. You can turn them off in the set. Well, you can't turn it off, but you can. I have a black background, so I could just change these to black, change these two colors to black, and then they won't show up. They're still there. You just won't see them on your background. Okay, but there's no setting to actually turn them off. Like I said, you just can change the colors to match your background, and then you won't see them. Okay, so I don't know. I'm not sure if those are really helpful, but that's what those are, in case you're wondering. And it's going to show that on any chart. It's going to show what the next candle that's forming is doing at that moment, but there's no guarantee that it actually will end up that way. It's making a projection based on current price current price action. All right. So now how can you use it for trading? Well, you can see that it makes really nice structure levels. And I think overall it makes clearer structure levels, especially during kind of sloppy semi-range type markets, than candlesticks will show. and it will give you areas where you can really kind of make a determination whether you should go, short or long at an area, thinking that, okay, a trend's going to continue. So if we take this uptrend right here, so we put in this low, we went up. Okay, now we were coming out of a downtrend, so you may have gone short right here. That would have been a legitimate trade, although it didn't break structure. But let's say you said, okay, you see this one close, a big wick. I'm going to go short right here. Boom. Okay, you go short at the close of this one, put your stop above here. It did go down, and you would have made some pips. And in fact, you would have made about 50 pips, right? Because again, you went short at the close of this one. This is a 50 pip candle. So you would have made 50 pips from here to here. Okay. If you had closed it, when this candle closed. However, you can see the very next candle came back and pretty much wiped that out. And the next one certainly did, went back through this big wick. So at this point, you would have said, okay, well, maybe we're having a reversal. We just put in a higher low, and now price is going higher. So now we were in an uptrend. You can see, boom, we got 1, 2, 3, 4, 5, 6 candles in a row green. This is 300 pips in these 6 candles. How long did this take? Well, let's see. Again, this is not time-based, but just to, again, show you that this is not time-based. This candle was April 2nd, 7 a.m. on April 2nd. This one was 6 p.m. on April 7th. So it was basically 5.5 days it took these 6 candles to form. So they're almost like daily candles, okay? But green, 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 all the way up. So you could have just held this, okay, because kept forming green candle, green candle, green candle, green candle, and then boom, okay? Now, if I change this to 250, it's going to just show a lot more green candles, and there could actually be a couple of small red ones in there, which is why I like the higher ones better, because this is just, would have kept you in this trade. Your first time you would have thought about exiting would have been right here, because now it throws a red candle. And you're like, oh boy, okay. And then comes down a little bit, tries to go higher, okay. And then it doesn't quite get higher. And then you get this red candle, throws a wick higher, tries to go higher, rejects again. All right. And then it comes down. You're like, uh-oh, maybe the uptrend's over. So maybe you exit. Maybe you even go short right here. Again, I like to be realistic. You look at this right here. Say, okay, well, we threw a rejection, red candle, we're going to get a reversal now. Maybe this downtrend here is going to continue. I don't know. You go short right there. And again, we're not changing the range here. We're just looking strictly on the 500. And you go short. And again, you would have had some profit here, right? Went down, this candle closed. All right. But if you left this open and then the next candle comes back, it would have wiped you out and you'd be back to break even, in which case you probably would have closed this trade at this point. Because again, this is showing you very strong, unlike a candlestick. If you see one of these candles paint and close, then there is some serious buying or selling behind that candle, because it's going to take 50 pips for this candle to print. So to get this 50 candle to print, there's got to be some pretty strong buying. So if for some reason you didn't close right here and you let it run, and all of a sudden you see this green candle forming. Now, again, this would have been a projection candle. It would have started off with that translucent green. And that's maybe another use for the translucent color, to say, uh-oh, the next one's painting green. I think I better get out. So you could do that. But let's say you didn't. You'd end up basically back to break even. You close that trade, basically essentially break even from the close of this one to the close of this one. And then you can think about continuing the long, and boom, you go long. And again, you get another 1, 2, 3, 4, 5, another 250 pips. And then we get this choppiness, and then it goes up again. Okay, now this choppiness, let's look at that. Again, what's nice about the range bars is it really helps you look at the consolidation areas a little better. If you look at this, all right, there was never really a break of any of this structure. We had price come down, okay? It broke, it came down here, tried to go higher, it failed, but then these bear candles never broke structure. Then it tries to go up again, fails, comes down again, failed to break this structure again, where the last swing low right here, then comes up again, and then it breaks it, but it closes higher back inside the range green, okay? So it shows you these ranges very well, and it shows you the rejection in the market structure really, really well. Okay, and can keep you potentially out of bad trades. And it doesn't mean it's going to work every time. Sometimes it might go beyond there and give you a false move, and then continue in the direction of the trend. But in this case, and I see this a lot in the back testing, it holds these structure levels. So all of this noise in here you can ignore. And in fact, depending on your stop loss, you could have gone long to continue this uptrend on this candle or this one. Certainly this one would have been good. But even if you had gone long on this one and this one, you would have gone into some break even or drawdown. But as long as your stop loss wasn't too tight, because obviously you could have been stopped out on this one. It came down here, swept the liquidity below these lows, and then went higher. And that's why I always tell you guys to be a little bit more generous with your stop loss, okay? Don't put it exactly right at that swing higher low, because you get wicked out only to see the market go in your direction. Give it a little breathing room, position your trade right. So if this is too big of a stop loss from here to here, then just size down a little bit, right? You don't have to swing for the fence on every trade. You still have the option to control your risk, in your trade size, okay? And you can see this would have kept you out of the bad trades. But even if you went long here, you just would have had to sit through a bunch of drawdown or sideways break even from, this was Sunday, April 19th. So this is the market open on April 19th. Finally, the uptrend started again. That's what I'm saying. Look at when the uptrend really finally resumed, was April 29th. So we had April 29th on this candle. We had April 19th here. 10 days. This market went nowhere for 10 days. Okay. All right. But the nice thing is it's showing you that it's not moving. And so you're not going to get lured into taking a trade just based on regular candlesticks that may have big ranges and big giant wicks. And you're like, oh my God. And you just get whipsawed. And this is showing you there's prices consolidating. It's not breaking the structure. So there's no place to go short here. And there's really no place to go long either if you want to wait for a breakout, because the breakout really didn't occur. I mean, really didn't occur until near the top of this, but, really until about this candle right here. And then it pulled back again. It did go, finally went up and made a new high. And then, we consolidate again. Range bound, it's not going higher. So no trade in here. Again, it's showing you this, the market's not going anywhere. And again, this was from May 5th through May 14th. So again, 9 days in here, price went nowhere. And then it comes down here, boom, it breaks structure. It breaks this old structure. This is telling you the market's probably going to start trending lower. Again, it pulls back right here. Another consolidation area, another little pullback. Now, if you're waiting to go short right here, then, this is where you want to start looking. At this point, on this pullback, here's your range right here, right? This is basically your range. Tighten this up a little bit, right? Here's the pullback. Here's the range. Over here. Okay. There's your range. Price did not break this range until this candle, right? Maybe you could have entered here because now you got two solid, but right here on this candle. So it would have kept you out of this chop, hopefully. And although maybe it wasn't a perfect ideal entry, maybe that's when you drop to the 250 range. But, you get in right here, and then you got this big move down, and there you go. Okay. So the whole point of these things is that they show you, to me, they show clearer market structure levels. They help keep you out of consolidating markets, because it holds the market structure levels very, very nicely in most cases, not always, better than regular candlesticks. And it forces you, again, to sit on your hands and wait for a range to finally break, okay, before you choose to either jump into a new trend or or jump into a continuation. And like I said, sometimes you might get fooled, right? Like when we're talking about this and you went short right here, you still could have made 50 pips here. But overall, the market's still up. We just came out of a very, very strong move up. So you really think you're going to want to short right here? I don't know. The market structure at this point is way down here, and price did not get anywhere near that. And so, yes, I guess you could have taken a short right here, thinking that this uptrend was over. Maybe we're going to resume this downtrend. But overall, you would have just waited for the pullback, okay? And, you know, this would have been your entry candle right here. You're thinking, okay, this is going back up. Boom, we got this liquidity drain right here, goes down, takes out stop losses, maybe below here. People maybe tried to go long on this candle, which is inside the range of these previous candles. So I probably would not have taken that. Okay. And then it pops out of the range here on this candle and then comes right back. And then this is your entry to go higher. All right. So listen, there's no magic. It's not perfect. It still takes a little bit of discretion and patience. But what I like about it, again, is it shows market structure really well. It shows consolidations really well. It forces you into patience because you can see those consolidation zones very clearly. And whether you wait for liquidity sweeps or breakouts on the other side, whatever your taste is, you can do that. Okay. And then you just trade based on that. So we come back here looking at this Aussie dollar where we are now. All right. So what's the deal? Well, like I think we already talked about this. We put in this low, we put in this what looked like maybe a swing high, and then the very next candle comes back right here, and now it's green. Okay, we have this, we basically wipe it out. So again, to me, the range is right here now. All right, got that high, and we got this low. So if you want to be patient, of course, you can try to, peg the market early on like a big wick in or out of this range. If it wicks down here and closes higher, you can go long. If it wicks up here and then closes back inside the range red, you could go short. Certainly could do that. Or you can just wait for a green candle to close outside this range, above this high, closes, somewhere over here. As soon as that candle closes, you go long, or same thing to the downside. As soon as it closes red below this range, because you can see now we've got 3 candles holding this range inside of this range. This one's got a big wick, but it closed back in the range. Then this is your entry with a red candle range bar close outside of this zone, and you go short. Okay. And, this market is trending down, but, could be over. It could be the reversal. We did come back to we came back to this swing low back here. So maybe this is just, rally up, comes all the way back. This is a classic, supply and demand play, right? Although this took a long time to play out. This was March 31st. This was 3 months it took from here to come all the way back. From here to here is 3 months, okay? Took a long time to play out, but it could be a classic, demand play where price rallies, comes all the way back to the original supply zone, but we'll see. I'm not really big into that. I'm looking at what price is doing now. The only thing I'd be using this for, like if I was in a short right here, I'd be looking at, this area. If I was short from like up here somewhere, my target probably would have been here. I don't necessarily go for the extremes, because a lot of times price doesn't get there. And this is an example where it didn't get there. Maybe it does eventually, but my take profit would have been at this slightly higher swing low right here. And even that, you may have not have been pegged. Maybe you would have just hit it. So, all right. So those are range bars, guys. Like I say, you really can't use it necessarily with the currency strength indicator. If I throw that on there, yeah, it won't even draw it. You see the little red exclamation point? And so it won't even draw it. So you can't use it with the currency strength indicator because that is based on time and everything. So it's not going to work. So you can't use it with that. But you can use it with other indicators like oscillators, moving averages. Here's a couple moving averages. You can use it with that. But on a custom indicator like the CSI, I cannot use it. Okay. So this is something you would trade either just on its own or with moving averages or maybe an oscillator. I think it'll work with an oscillator. We just throw throw the stochastic on. Whoops, no, stochastic. Yeah. So there's just a regular stochastic. It works with that. Okay. So you certainly can use it for that if you want, but I don't really think it's necessary. So get rid of that moving average. There you go. Okay. So those are range bars, guys. Pretty cool. How long have we been talking here? 45 minutes. Good Lord. All right. I need to wrap this video up. Okay. So range bars, guys, available in TradingView. Again, depending on what time frames you normally like to trade on using candlesticks. Are you a scalper? Are you a day trader? Are you a swing trader? Are you a position trader? The higher you go up that ladder, the higher you want to set the R. Okay. And you can create whatever custom interval you want, as I showed you. The way I would do it is whatever your analysis time frame is, let's say in my case, the daily, then you can set this to like 500. Put two charts side by side, put the regular candlestick chart on one on whatever time frame you prefer. And then on the other side, have the range bar chart and adjust the range bar interval so that it sort of matches at least the overall flow, swing highs, swing lows, overall structure of the market. Don't worry about the detail. That's not important. But the overall flow of the market, right? Up, trending down, sideways. And when they look pretty similar, then you probably are fine-tuned, about where you should be. Okay. And you also could use this in combination with candlestick charts. So let's say you are looking for an entry right here. Although you don't need to, you could go and switch back to candlesticks. All you got to do is just click candlesticks or whatever. And you can go back here and say, all right, I'm on the 4-hour chart now. I'm just going to wait for, do we have a break of structure? So you can see here on the regular candlestick chart, if I'm thinking I'm going to go short, well, maybe I want to wait for price to come down here and break these lows, and then I'll go short. So you can use it in combination with regular candlesticks, or just adjust the interval on this. Go from a 500 down to a 800. Okay. Here's that same kind of swing low we just saw on the regular candlestick chart. So, say, oh, well, if I'm looking for a short, you can see this is making higher lows. But if this comes down now and takes out, say, this little low right here, this swing, right? This is now trending down. Let's say this ends up being a lower high and it comes down, breaks this, then that could be your entry. So again, you don't have to use just that one range. You can either drop to a shorter range to fine tune an entry or an exit, or you can switch over to regular candlesticks and use a shorter time frame, whatever you like. Okay. But I would start on the range setting that mimics the time frame you like to do analysis on, and then you certainly could just enter off of that. But like I said, if not, use a shorter range to give you that little more granularity and look for that market structure shifts, or go over to candlestick charts and do the same thing. All right. So something a little bit different, guys. I hope that was helpful. If you have questions or comments, leave them down below. Let me know what you think about this. Have you ever used these charts? What do you think about it? Do you think they're any better than candlesticks or Heikin-Ashi or anything else, which are all, time-based charts? So let me know. I appreciate it. Have a great weekend. Next week should be a little bit normal week for me. I'm not going to be on the road again for another 3 weeks or so. So I should be around, and we'll go from there. I'll probably do an analysis maybe on Sunday this weekend based on the range charts. I'll go through them, and maybe we'll look to see based on this whether there's anything setting up and what I'll be looking for. And we'll take a quick look at futures. I haven't forgot about that. I don't trade this with futures. I'm telling you that because I mostly just day trade it. I haven't gotten to that point yet. I did take 2 futures trades, about $300 profit. I did not use the range bars. I just used my regular moving average system on the 1-hour chart and just look for quick hits, off of support. But I probably will begin to test this with the range bars on futures, but I would have to set it to a lower setting because I don't trade the daily chart or anything that high in futures. So for now, this is just for Forex, but I'll continue to evolve it a little bit. And again, let me know your comments and thoughts, guys. Have a great weekend. Talk to you all soon.